Assalamualaikum and hi guys, my name is Ahmad Badru Amin bin Mohlisin. Today I want to talk about subtopic in chapter 5, which is insurance and pension. Firstly, I want to talk about insurance. So, what is insurance? Let's go. Insurance is a contract represented by a policy in which an individual or entity receives financial protection or reimbursement against losses from an insurance company. The company pulls clients' risk to make payment more affordable for the insurer. Insurance policies are used to hedge against the risk of financial losses, both big and small, that may result from damage to the insurer or her property or from liability for damage or injury caused to a third party. So next, how insurance works. There is a multitude of different types of insurance policy available, and virtually any individual or business can find an insurance company willing to insure them for a price. The most common type of personal insurance policies are auto, health, homeowner, and life. Most individuals in the Malaysia have at least one of these type of insurance, and car insurance is required by law. Businesses require special types of insurance policy that insure against specific type of risk faced by a particular business. For example, a fast food restaurant needs a policy that covers damage or injury that occurs as a result of cooking with a deep fryer. An auto dealer is not subject to this type of risk, but does require coverage for damage or injury that could occur during test drives. There are also insurance policies available for every very specific needs, such as kidnap and ransom, medical malpractice, and professional liability insurance, also known as error and omission insurance. So, next, I will discuss about type of insurance. The first type of insurance is life insurance. What is life insurance? As the name suggests, life insurance is insurance on your life. You buy life insurance to make sure your dependents are financially secure in the event of your ultimate demise. Life insurance is particularly important if you are the sole breadwinner for your family or if your family is heavily reliant on your income. Under life insurance, the policyholder's family is financially compensated in case the policyholder expired during the term of the policy. The second type of insurance is health insurance. Health insurance is bought to cover medical costs for expensive treatments. Different types of health insurance policy cover an array of diseases and ailments. You can buy a generic health insurance policy as well as policy for specific diseases. The premium paid towards a health insurance policy usually covers treatment, hospitalization, and medication costs. The next type is car insurance. In today's world, in today's world, car insurance is an important policy for every car owner. This insurance protects you against any untoward incident like accident. Some policies also compensate for damage to your car during natural calamities like flood or earthquakes. It also covers third-party liability where you have to pay damage to other vehicle owner. Next type of insurance is education insurance. The child education insurance is akin to life insurance policy which has been specially designed as a saving tool. And education insurance can be a great way to provide a lump sum amount of money when your child reaches the age for higher education and gain entry into college, which is 18 years and above. This fund can then be used to pay for your child's higher education expenses. Under this insurance, the child is the life assured or the recipient of the funds, while the parents or legal guardian is the owner of the policy. You can estimate the amount of money that will go into funding your children's higher education using education planning calculator. And the last type of insurance is home insurance. We all dreaming of owning our own homes. Home insurance can help with covering loss or damage caused to your home due to accidents like fire and other natural calamity or perils. Home insurance covers the instances like lightning, earthquakes, and many more. Next, I want to talk about insurance policy components. When choosing a policy, it is important to understand how insurance works. A firm understanding of this concept goes a long way in helping you choose the policy that best suit your needs. For instance, whole life insurance may or may not be the right type of life insurance for you. There are three components of any types of insurance, which is premium, policy limit, and deductible that are crucial. Okay, first I want to discuss about the premium. A policy premium is its price, typically expressed as a monthly cost. The premium is determined by the insurer based on your business risk profile, which may include creditworthiness. For example, if you own several expensive automobiles and have a history of reckless driving, you will likely pay more for an auto policy than someone with a single mid-range sedan and a perfect driving record. However, different insurers may charge different premium for similar policy, so finding the price that is right for you requires some legwork. Next, I will talk about policy limit. The policy limit is the maximum amount an insurer will pay under a policy for a cover loss. Maximum may be per set period, for example, annually or policy terms, per loss or injury, or over the life of the policy, also known as the lifetime maximum. Typically, higher limits carry higher premiums. For a general life insurance policy, the maximum amount the insurer will pay is referred to as the face value, which is the amount paid to a beneficiary upon the death of the insurer. And last is deductible. The deductible is a specific amount the policyholder must pay out of pocket before the insurer pays claim. Deductible serve as deterrent to large volume of small and insignificant claims. Deductible can apply per policy or per claim depending on the insurer and the type of policy. Policies with very high deductibles are typically less expensive because the high out-of-pocket expense generally result in fewer small claims. And next, I want to talk about importance of insurance. Why insurance is so important? because insurance can provide safety and security to individuals and businesses. Insurance provides financial support and reduce uncertainties that individuals and businesses face at every step of their life cycles. It provides an ideal risk mitigation mechanism against events that can potentially cause financial distress to individuals and businesses. For instance, with medical inflation growing at approximately 50% per annum, even simple medical procedures cost enough to disturb a family's well-calculated budget. But a health insurance will ensure financial security for the family. In case of business insurance, financial compensation is provided against financial loss due to fire, theft, mishap related to marine activity, other accident. Next, the importance of the insurance is generate long-term financial resources. The insurance sector generates funds by way of premiums from millions of policyholders. Due to the long-term nature of this fund, these are invested in building long-term infrastructure assets such as roads, ports, power plants, dams, and so on that are significant to nation building. Employment opportunity are increases by big investments leading to capital formation in the company. And the next point is promotes economic growth. The insurance sector makes a significant impact on the overall economy by mobilizing domestic savings. Insurance turns accumulated capital into productive investment. Insurance also enables mitigation of losses, financial stability, and promote trade and commons activity. Those result into sustainable economic growth and development. Thus, insurance plays a crucial role in the sustainable growth of a company. And the next point is provide support to families during medical emergencies. Well-being of family is important for all, and health of family members is the biggest concern for most, from elderly parents to newborn children. Medication and hospitalization play important role while ensuring well-being of family. Rising medical treatment costs and soaring medicine prices are enough to drain your savings if not well prepared. Anyone can fall victim to critical illness such as heart attack, stroke, cancer, and many more unexpectedly. And rising medical expenses is of a great concern. Medical insurance is a policy that protects individuals financially against different types of health risks, which a health insurance policy and insurer get financial support in case of medical emergency. Okay, this is the last point. The split risk. Insurance facilities insurance facilitates moving of risk of loss from the insurer to the insurer. The basic principle of insurance is to spread risk among a large number of people. A large population get insurance policy and pay premium to the insurer. Whenever a loss occurs, it is compensated out of corpus of funds collected from the millions of policyholders. Next, I want to talk about pension plan. Okay, first, what is pension plan? A pension plan is a retirement plan that requires an employer to make contribution to a pool of funds set aside for a worker's future benefit. The pool of funds is invested on the employee behalf. and the earning on the investment generate income to the worker upon retirement. Okay, pension plan. In addition to an employer-required contribution, some pension plans have a voluntary investment component. A pension plan may allow a worker to contribute part of their current income from wages into an investment plan to help fund retirement. The employer may also match a portion of the worker's annual contributions, up to a specific percentage or dollar amount. There are two main types of pension plan, which is the defined benefit and the defined contribution plans. First, we will talk about the defined benefit plans. In a defined benefit plans, the employer will guarantee that the employee receive a definite amount of benefit upon retirement, regardless of the performance or the underlying investment pool. The employer is liable for a specific flow of pension payment to the retired, which is the money amount is typically determined by a formula usually based on earning and years of service. And if the assets in the pension plan are not sufficient to pay the benefits, the company is liable for the remainder of the payment. Next, we talk about defined contribution plans. In a defined contribution plan, the employer makes specific plan contributions for the worker, usually matching to varying degree the contributions made by the employees. The final benefit received by the employee depend on the plan investment performance. The company liability to pay a specific benefit ends when the contributions are made. Next, what is benefit of a pension plan for employee? First benefit that we get is lower management fees. Management fees are normally deducted directly from the return achieved by managers. Investors may believe there are no fees, but that's not true. Management fees are generally much lower in group plans than which funds offered by banks to individual investors. Saving a mere 0.5% on management fee can mean several $1,000s more at retirement. Next, tax shelter recognition of invested money amount. With a pension plan, employees can accumulate funds while deferring income tax on their investment returns. Normally, the income tax will be paid several years after the contribution when the employee withdraws the money upon retirement. And next is increased savings through payroll deductions. The contributions paid into a group pension plan are directly withheld from the employee pay, thus making it much easier to save. It proven that individuals will be more money aside when they don't have to transfer manually an amount of their account to a retirement saving plan. Okay, next. Next point is immediate tax savings. The contribution withheld deduction for employee pay are made in pre-tax dollars. Therefore, employees don't have to wait until their income tax return is filed at the beginning of the following year to recover a tax overpayment. Saving taxes which each contribution paid into the plan will contribute to higher return over time. Next point is access to leading investment managers. The funds offered through group plans are run by managers whose expertise is recognized in the industry and who are continuously reviewed and monitored by the insurer. And investment solution for everyone. Whether you are an expert or a novice in financial matters, group plans offer various approaches for meeting your retirement objective. Several tools and services are also available to guide you in the selection of investment. And this is the last point. Employer match. When an employer decides to make contributions to the group pension plan, the plan becomes even more profitable for employees as the accumulated funds will grow faster. No individual plan allowed for matching contributions. And I will go to the advantages of pension plans. The first advantages is this is opportunity to diversify across asset classes. Most pension funds give investors an option to choose the asset class to which they would like maximum exposure. As an investor, you can choose amongst pure debt, pure equity, or mix of debt and equity. The next advantages is benefit of long-term investing. Since this scam Since this scheme invests for the long term, your investment can reap the benefit of long-term investing. Pension plans ensure that a good corpus is accumulated by the time you retire and create an annuity which can provide a steady flow of cash post your retirement. The next advantage is multiple options for payment. Pension scheme usually offer investors a great deal of flexibility in terms of how they want to make the payments. Investor can choose to invest a lump sum amount and receive immediate annuity payments, or they can choose a deferred annuity plan which will let their corpus earn more interest until the payouts begin. Can provide the benefit of life insurance cover is also advantageous. Certain pension plans offer a life cover as well, in which a lump sum amount is paid to the family members or nominee at the death of the insurer. And the last advantage is can access to a lump sum amount during an emergency. Investors are allowed to make certain adjustments to their pension policy and access funds in case of emergency. These emergencies are predefined. And lastly, for the conclusion, pension insurance contract is an insurance contract that specifies pension plan contribution to an insurance undertaking in exchange for which the pension plan benefit will be paid when the members reach a specific retirement age or on earlier exit of members from the plan. A pension is a fund into which a sum of money is added during an employee's employment years and from which payments are drawn to support the person's retirement from work in the form of periodic payments. A pension may be a defined benefit plan where a fixed sum is paid regularly to a person, or a defined contribution plan under which a fixed sum is invested and then become available at retirement age. Pension should not be confused with severance pay. The former is usually paid in regular installment for life after retirement, while the latter is typically paid as a fixed amount after a voluntary termination of employment prior to retirement. The terms retirement plan and superannuation tend to refer to a pension granted upon retirement of the individual. Retirement plans may be set up by employer, insurance company, the government, or other institutions such as employer association or trades unions. Retirement pensions are typically in the form of a guaranteed life annuity, thus ensuring against the risk of longevity. A pension created by an employer for the benefit of an employee is commonly referred to as an occupational or employer pension. Labor unions, the government, or other organizations may also fund pensions. Occupational pensions are a form of deferred compensation, usually advantageous to employee and employer for tax reasons. Many pensions also contain an additional insurance aspect, since they often will be pay benefit to survivors or disabled beneficiaries. The common use of the term pension is to describe the payments a person receives upon retirement, usually under predetermined legal or contractual terms. A recipient of the retirement pension is known as a pensioner or retired. Thank you for discuss with me about pension and insurance. So that's all from me. Thank you.